turn off the camera just for the presentation. We'll put it back on at the end in case any questions or anything, but I just know with the ESB and everything, I'm just afraid that something is going to go on the broadband when they use the presentation screen and the camera. They generally tend to weaken. So I'm just going to turn off the camera if nobody minds, and we'll just talk through the actual slides. I'm also conscious as well that play schools and schools are closed today, so you could hear a bit of knocking in the background. It could just be a Christmas tree falling or something, so just completely ignore it. I can't help it, or fill them full of jellies to keep them quiet, so that probably is not going to help it either. But anyway, we'll just make do with it. Okay, so the Consumer Insurance Contracts Act. Now, this is really just a high-level detailed chat we're going to have about it. We're not going to touch off it word by word. It's a very large piece of legislation, and if we're to go through it section by section, we'd be here for the day. We'd be debating ins and outs, what it means, interpretation, what it doesn't mean, and half will probably be asleep from the end of it, because CICA, like everything regulatory, doesn't come with big flashing lights of excitement. It's more kind of an eye-rolling thing when people hear it. It's just, at the moment, it's just a gift that keeps on giving for insurers and brokers alike. Okay. And just for the proper bit, this is only my opinions. It's not a legal representation. It's not a legal opinion. So if you require further clarification on anything that I say or anything that's discussed, please seek legal advice on it. This is, as I said, it's only my opinion and discussions that I've had with people regarding the content of the CICA. So what we're going to look at today, there's just an agenda. We're just going to consider the Consumer Insurance Contracts Act, the what, the who's, the whens and why, the scope of the acts and sections in place in September 2020. They include insurable interest, cooling off period, claims handling duties, deferring payments and subrogation. There was also a second phase that we refer to as phase 2 that came into effect on the 1st September 2021, the utmost good faith, misrepresentation and renewal of contract insurance. And we're going at the end of it then, we'll probably just talk about how it affects insurers in the market now, the extra ask that we have to do, the extra documentation, and what we're now required to give the insured. Now, if any of you have any questions at any stage, just put your hand up, or you can keep it to the end, or just put something in the chat box. There's no problem at all, we can stop. So just a brief background and scope of the act. I'm sure everyone is pretty familiar with CICA by now. If you're not, and you haven't heard about CICA and you haven't heard much going on about it, you probably should go talk to someone, because it's it's been everywhere for like the last year and a half, almost 2 years. But on the 26th of December, obviously a slow year, they were that busy 26th even today, December 2019, the Consumer Insurance Contracts Act was signed into law by the President. It was based on the Law Reform Commission's 2000 report on consumer insurance contract, and the Act is a significant development in insurance law for consumers. On the 17th of July 2020, the government announced that this Act will be commenced in 2 stages, with the bulk of the provisions taking effect on 1st September 2020. So that's why they refer to them as phase 1 and phase 2, so that was easy for insurers and consumers to tell the difference between the two. It applies to insurance contracts with individuals and businesses with a turnover of less than 3 million. The Act applies to life insurance, non-life insurance contracts agreed or varied or renewed following commencement of the Act. So as any policies that came into effect or renewed, or any claims that were notified on 1st September 2020 onwards. It places more significant obligations on insurers and has some of the following impacts across all lines of business. Amending pre-sale and post-sale documentation across all products to be consistent with legislation, additional data capture and disclosure requirements, revised renewal regulations to capture 5 years premium values across all products and add the claims history schedule to all products, internal underwriting and claims process change to reflect the requirements of the Act, including staff training. Internal underwriting and claims process require modifications to reflect the requirements of the bill. Internal and external training and communications to outline changes introduced by the Act. Insurers that might deal with vendors, TPAs, etc., that kind of thing. So the Act was really putting a large obligations on the insurers and how they do business, including like their internal process, their internal documentation, the systems they use, what kind of data they capture, how they capture it, how they release the data. So there was a really big ask here on insurance to make these regulatory changes to the documentation, the correspondence that they sent to insurers. It wasn't really a simple, okay, we'll change that now, or a box ticking exercise. This was a big, big project for all insurers and brokers alike. So as I said, what was in place in September 21 was the insurable interest, cooling off period, claims handling duties, deferring payments, representations and subrogation. And we're going to look at those in detail in the following slides. There was other smaller sections that were brought in, but as I said, we're not going to go through the whole act word for word, section by section on this call, because it's only a high level ask. But you can always, of course, if you have any queries, you can drop me an email or have a question at the end. So the insurable interest. The insurable interest is legal right to insure arising out of financial relation between the insured and the subject matter of insurance. Valid claims cannot be rejected if the claimant deemed not to have an interest in the subject matter of the contract. This is no longer a requirement and came into effect for the 1st September 2020. And I think initially when the Act was published, this did cause a bit of a flurry and a real buzz at the time, because people were kind of scratching their heads and they were like, how is this going to work? How do people not have to have an insurable interest? Is it a free for all? It was just, people really couldn't comprehend it from the offset, saying like it was always one of the most basic requirements in insurance that you must have an insurable interest in the property that you are actually insuring. But when they kind of done a bit more looking into the actual Act and the words of the Act, it wasn't really saying that you didn't have to have an insurable interest anymore. It was more so saying that the insurer had to ask the correct question at the time of quote or renewal to ensure that the risk being presented to them is cover that they want to take on, or they want to offer cover on that risk. So it's really back into the hands of the insurer to make sure that they asked the right question. So if you're insuring a car now, for example, you might be asked, are you the registered owner? If you're not the registered owner, you'll be like, well, why are you trying to insure the vehicle? Obviously it won't be as blunt as that, but they're the kind of questions that will come up now at these stages of renewal, or you're looking for a quote. The Act does not abolish the principle of indemnity, as I was saying, that it's not really a free-for-all. In relation to the insurable interest, the Act says that for contracts of indemnity, the insured can be required to have an interest in the subject matter of the contract, but that interest cannot extend beyond a factual expectation of an economic benefit or loss. So that's simply saying that, like, I just can't decide to insure my neighbour's house in the off chance that it might burn down and then take payment for it. I have no factual interest in that property. I never am going to have factual interest in that property, so I don't really have a right to insure it. The cooling off period is section 11 of the Act. They set down the Act that the cooling off period is now 14 working days. So before, people might have had 14 days, 10 days, 7 days. Everyone had kind of different cooling off periods. It's now 14 working days under the Act. It doesn't apply to contracts for less than a month. So if you took out your insurance contract with someone and you decided, you know something, I don't want this, I'm going to withdraw, you can take a cooling off period within that month. After that month, the cooling off period, after that month, the cooling off period doesn't really apply. No other financial costs other than the cost of premium. This affects de minimis applied by some insurers, especially in the cooling off period. What that's saying is that, like, some insurers may have, before the Act came into play, if you decided you didn't want to go ahead with the policy and you wanted to cancel it, they may have charged you an administration charge, it might have been 40, 50 euro for them actually cancelling that policy. That can't be done anymore. So that came into effect in 1st September 2020 in phase 1. So claims handling duties. The claims handling duties, a lot of these actually mirror what's in section 7 of the CPC. So there's not really anything new or surprising that came out of this. A lot of it was already a requirement on insurers and brokers alike because of the CPC. We'll go through some of them now. So notification of a loss within a reasonable time. Insurer cannot repudiate for late notification alone. There should not be a valid ground for the insurer to refuse liability, indemnity, unless the non-notification prejudices the insured position. So what may have happened before is, if there was late notification on a claim, regardless of whether it impacted the outcome of the claim or the damage or the monetary settlement, an insurer may have declined to deal with that claim using their late notification and saying, no, we're not dealing with it, you didn't reply in a timely manner, so we're not going to offer you indemnity. They can't do that anymore now. So unless the late notification directly impacts the claim and prejudices their position, then they can actually do it. So say, for example, it's a house claim and there is an escape of water, a visible escape of water, and the insured doesn't report it to the broker or the insured, and they leave the escape of water go on and on and on for a long time, and then obviously the damage is a lot worse than what it was, and then they report it. They've prejudiced their position, because we may have been able to get in there sooner, we may have been able to get a loss adjuster out, works might have been completed, and we could have got to settlement. It's the same on an employer's liability claim if they don't report an accident on, say, a site, and they report it 18 months later, but the site is finished, there's nothing there left to see, there's no witnesses, we can't get any details. Like, they've really prejudiced our position. We cannot investigate what actually happened there now. We cannot say if the insurer is even liable for the accident, if the third party does have a valid claim, because they didn't report it in a timely manner. We've been prejudiced now because the scene or the risk is gone. Like, there's no witnesses, there's nothing to say, there's no one to talk to anymore. So our position has been seriously prejudiced. I already covered the already established practices, Consumer Protection Code, and the best practice guides for claims handling. So we're obliged now to engage with the insured. We have to inform the insured of the amount which a claim has been settled for and the reason for settlement. So when a claim has been settled, normally an insured would get a final settlement letter, just telling them how much the claim was for and that it may impact future contracts, etc., etc., etc. What happens now is that you have to give them a breakdown of the claim, if it's third party, injury, own costs, professional fees, that type of thing, and also why the claim was actually settled. So it could just be a case of we're settling the claim in line with the cover offered by your policy, or following investigations we found you were liable, so we're settling the third party claim on best terms possible. It's just those type of inserts have to be added into the letters now to tell them why we're actually settling this claim. I think that the idea behind that was that there was a bit of noise before that insurers were settling third-party injury claims without informing the insureds, and there might have been a low velocity impact, or the insurer believed there was no injury. So I think it was trying kind of cross that hurdle in a fair way, that, you know, we've engaged with them. We have to, obviously, by CPC, tell them the outcome of investigations, and if we're going to settle a third-party claim. And then if we do settle a third-party claim, why we actually settled it, because we thought we completed our investigations and we found that we were actually liable. We also have to pay any sums due to the insurer in a reasonable time. And I think that's kind of getting at, if there's a couple of different payments on a claim settlement, it might be a personal injury claim, it might be a motor damage part of that claim, there could be a loss of earnings part of that claim. And the last two might be all ready to go and figures agreed. It's just the personal injury is outstanding. So what they're expecting to see now is that the personal injury claim will be left as it works its way in the background, but you can actually pay the claimant the damage claim and their loss of earnings claim, because those figures have been agreed. So you don't have to wait until the injury claim is settled, or you're waiting on medicals. And obviously now with COVID and everything, medicals can take a long time to come through. It's getting better now whenever we open up again, but there was an awful delay last year. So it's just to put claimants so that they're getting whatever payments are agreed, they're getting those in a timely manner, rather than waiting until everything is sorted at the very end. So the insureds have duties as well, in line with the Act. They must cooperate with the insureds in the investigation of insured events. So if we're requesting information from them, they are obliged to give us that information in a timely manner. They will also notify us if an occurrence of an insured event within a reasonable time, or in accordance with the terms of the contract. If something happens that may lead to a claim, or they think may lead to a claim, or has led to a claim, they are obliged under the Act to inform us of this incident and let us know what has happened. Penalties will apply for non-compliance of this. It's a bit kind of, I don't know who's policing the insureds or the consumers in these kind of instances, or who's saying they haven't done something that they should have done. It's going to be a bit, obviously, because the Act is still so new, there's been no challenges yet, or there's been no legal proceedings on anything that has been challenged by an insured to say, you know, what the outcome was. So it's a bit like the new personal injury guidelines. People are going to have to wait to see what happens in a court sitting before they'll set a precedent for any kind of complications or any penalties that might occur down the line with regards to these type of things. And when the Act was initially released, Section 1610 was with regards of sharing of information to a claimant. There was a bit of a worry and concern regarding the wording, and that it imposed on disclosure of legally privileged information to claimants, and that was going to cause a bit of an issue because it's legal advice and obviously it's privileged and we shouldn't have to share that. So it was paused, 1610 was paused, and it wasn't brought into effect, and they said they'd revisit that, and that since has been revisited. What the plan now is, or what they're saying they're going to do now, is that 1610 is going to be deleted completely from the Act, and they now propose to insert two new headings, 16A and 16B. The General Scheme of Insurance Miscellaneous Provisions Bill 2021 was actually released kind of towards the end of October, and it gave details of the heads of the proposed amendments and additions they wanted to bring into the Act that might address this concern that people have with regards to legal privilege. So 16A is a direct, is directly in reference to section 16.10. But unfortunately, the way the bill has been proposed at the moment, it's not, if you're to read it literally, it's going to cause a lot more problems for insurers than what it should. Essentially, what they're saying at the moment is that any information we get on a claim, regardless if it's an insured or third party, we have to share immediately to the claimant. If it's subject to legal privilege, you have 60 days and then you can actually share it. So you can just imagine from a claims handling point of view, how that's actually going to work. How would it work that you're essentially have to share everything with a third party claimant, including personal injuries, say sharing CCTV, like there's the finer things when you go into nitty gritty, like GDPR, who is going to pixel out the CCTV, who's going to hide the personal details and reports that you don't want the third party solicitor or third party claimant to have just because GDPR breaches, and just the general just around protecting our insured, as in like we have a right to protect our insured and handle claims the best way possible. So if we're going to defend a claim, we're going to defend it. But now reading 16A, the new suggested wording, it's making that very, very difficult, as in you have to show all your hands. It's essentially taking the legal proceedings from the court and putting it into the claims handling process, which you can imagine is just going to be very, very difficult and very, very hard for people to work its way around. Now, obviously, it's not written into law yet. It's only the bill that's out. There has been concerns raised around the complications and the problems that it could actually arise from it. So that has all been fed back. So we're just waiting at the moment to see what will come forward now with regards to our concerns. Will they tighten up on the wording? Will they actually say that it's only with regards to insureds and not third parties, or what the outcome of that will be? So until we hear more from that, it's all still slightly up in the air a bit. A new one they brought in after COVID was section 16B. That's what they're suggesting they're going to put in. And that addresses the concerns of deductions from settlements of claims where deductions involved public monies. That's excluding RBAs. And I think that came around the time of the COVID and the business interruption claims, that people had concerns that insurers were deducting the wage subsidy payments or the PUP or any grants that were given to insurers, that they were being deducted for the final claim settlement amount. So now the insurer has a duty to inform a consumer regarding deductions to claim settlement amounts that they're making on that claim settlement. The only problem is with the wording on head 8 for section 16B is that it's referring to public monies, and public monies could be divided a number of different ways depending on the person that's reading it. Like if it was to address just the COVID payments and the business interruption, it probably should have said that with regards to settlement. But now when you say public monies, do they mean that they're getting at hospital bills or A&E charges? Like, can that be took as public monies? Could VAT be took as public money? Like the insured, if insured is VAT registered, they're entitled to claim VAT back from the government. Could that be seen as public money? So it's really just, it's the interpretation of the person that's reading it and what they want to define as public money. So I think that's obviously raised concerns as well, and that's been referred back because they said they want the wording to be more clear in what actually happened or what they're saying is going to happen. So that's something that's going to come around after Christmas, I'd say, and you probably will hear a bit more about it if the wording has been changed, or if their government are happy enough to go with what's been said in the miscellaneous provisions, which will obviously lead to massive concerns and changes for insurers and obligations and insurers to provide information or change their systems to provide further information to the insured. So it'll be a big ask. Section 17 is in relation to deferring payments on claims. It applies to property claims where insurers retain a portion of the payment, known as retention, pending receipt of certain information, invoices, on completion of all works. So normally what would happen in a property claim was, if the claim was of a large size, a final settlement would be agreed, a retention amount will be set aside, and the insured will be paid the remainder amount. Once they then provide all the invoices, should all the work has been completed, the retention amount is then released to the insured. So this has changed now since September last year, in that we're only allowed to hold a certain amount. So if the final claim settlement amount is 40,000, the maximum we can hold in retention is 5%. And it's the same if it's over 40,000, the maximum that can be held is 10%. So retention amounts have gone very, very, very small. And you see what some insurers actually do now is the retention amount is small. Rather than the admin of keeping the claim open and chasing, they may just pay the full amount and forget about the retention amount, because sometimes the retention amount might only be a couple of hundred. So for just the admin reason, operations alone, they just pay the full amount. It's important to note here that the provision is void unless, prior to the commencement of the relevant contract of insurance, the retention provision is brought to the consumer's notice on paper or on another durable medium. So the insured has to be aware of this in their policy and their pre-contractual obligations. So we have to tell them before any policy comes out. We have to tell them that we do hold we do have a retention clause, that we will hold retention. But it's also at the time of making the claim, if the insurer does not bring this to the insured's attention again a second time, we actually can't hold retentions. We can't invoke the provision. We have to. So we don't tell them at the time of entering the contract, and at the time of also making a claim, that we do have a retention provision. We are not allowed to use this, and we're not allowed to hold any retention amount on any claim regardless. Just want to bear in mind the fact that you have to tell them twice, pre-contractual and at the actual time of making a claim. So people would have had to amend their wording, their FNOL packs, just to show that it does reference retentions. Proportionate remedies and claims handling. So this is in relation to when something might come to the insured's attention when a claim has been made with regards to something that was said by the insured. Normally, under all circumstances, the insured had the right to just cancel the contract. So obviously the contract is cancelled, there's no claim. That's changed now. So now there's 3 types of misrepresentation. There's innocent, there's negligent, and there's fraudulent. So the insured must decide which type of misrepresentation it is, and then what the appropriate remedy is. So if it's an innocent misrepresentation, the insurer must pay the claim and it'll go on as normal. And negligent misrepresentation, the remedy must reflect what the insurer would have done had it been aware of the full facts, and should be based on a compensatory and a proportionate test. So it'll just be would they have entered into the contract regardless if they had known the full details, and if it is, then they can continue to settle the claim, but they might make a deduction in relation to the misrepresentation or what kind of proportion misrepresentation held when it was made. A fraudulent misrepresentation, the insurer is entitled to avoid the contract in full. However, if there's a previous valid claim under the policy, it's not effective, so you have to treat that completely separate, that claim is handled as normal. You don't think that, they had a claim in there last week, it was fraudulent, we found something fraudulent on it, or there was a negligent misrepresentation. You have to keep them as 2 separate. It's almost like a Chinese walls, nearly. You have to treat the other claim completely separate from that and deal with it as normal, and not take into consideration what has come to light with regards to the second claim. Okay, so then we're on to representations by consumer and terms that reduce the risk being underwritten. So this again came into effect on 1st September 2020. The previous warranties are now considered to be representations. So warranties are essentially being removed from policies, and you can't imply warranties on insureds anymore. A basic declaration clause being warranted is not permitted. So any clause in a contract that converts the representation to a warranty is void. So if you have something in a policy that does that actually makes representation a warranty, you can't use it, because it essentially means that the insured is uninsured at the time of the loss. When you start investigating the loss and you see that it was a breach of a warranty or a base declaration, that you bring this to their attention and say, no, look, listen, this wasn't done, so we're not going to actually cover this claim. It puts the insured in a position where they wouldn't have known this, they weren't aware of this, so they wouldn't have had an opportunity to seek insurance somewhere else. So they're essentially uninsured for that loss, and just puts them in a very, very hard position that you can't actually do that anymore. It's legally can't be put into policies for insureds. A term imposed in a continuing restrictive condition shall be treated as a suspensive condition. Insurer's liability suspended for the duration of the breach, provided the breach increases the insurer's liability. So a very simple example of that is that the money is kept in a locked safe, so the insurer's liability is suspended whilst the safe is unlocked. If the breach is remedied by the time a loss has occurred, the insurer will not be entitled to deny the claim on the grounds alone. So say we go back to the safe example, the safe is locked up again, shop gets robbed. Because the safe was unlocked during the day, that doesn't come into it. The safe was actually locked by the time the loss occurred, so we will have to actually meet the claim considering if everything else is in order. A warranty is undertaken by the insurer to the effect that he shall or shall not do a certain thing, or that some conditions should be fulfilled, or whereby he affirms or negatives the existence of a particular state of affairs. The breach of warranty no longer gives rise to an automatic right or the part of the insurer to avoid all liability under the contract. So another simple example of that is the burglar alarm is not working. You obviously there's a warranty in the policy saying the burglar alarm is working at all times. However, the house then is flooded. The insurer cannot deny the claim on the grounds of the breach of the alarm clause, where the alarm clause active, where there is an alarm clause active on the policy. That's just saying because the clause didn't actually impact the loss or how the loss occurred, even though it was a breach, we can't actually use it anymore because it didn't impact the loss at all. So we can't deny on those grounds. Warranties may be expressed or implied. All oil rags, for example, it's all oily rags be kept in a closed metal bin. That's a bit of a mouthful there now, sorry. Section 21 then was rights of a third party to claim against the insurer. This was another one I think that caused a bit of a frow when it came out first, that people thought that anybody could ring up insurance companies and get your details and actually put a claim in against you, which is not, it's not really dare to do that. So if there's a liability insured with third party, the act vests the right to the insured in third parties in the event the insured has died, become insolvent, or missing. So it's not simply a case of I can't get him to answer his phone, so I'm going to put a claim in against him there now. It's not like people, I think people initially thought it was going to be that straightforward. Previously, if you had a policyholder who was missing, deceased, or insolvent, the third party would have had to apply to the court and establish liability before commencing legal proceedings, which is no longer the case. And to be fair to like an innocent third party, to have to go through that rigmarole when you are actually entitled to claim, or you have been injured, or your property has been damaged, it's a long road for them to have to go on, and it's no fault of their own that the insured is deceased, missing, or has become insolvent. So you can kind of see where the act was getting at in this way, that it does make it a bit easier for the innocent third parties. The same as if a third party might have contacted an insurance company and said that the so-and-so hit their car or something happened, and it turns out that like the insurer can't get in touch with the insurer can't get in touch with the insured, or the insured has become insolvent, that they're basically told, no, can't get in touch, we're not dealing with your claim. That again, like, I'm not saying insurers do it, but that's very, very unfair for an innocent third party. And like for the hoops they're expected to jump through then to try and get their property back to the way it was, or to get their own out-of-pocket expenses back for something that wasn't essentially their fault. So you can kind of see the thought process behind this. But I think people initially thought this was going to be worse, that anybody could put in a claim or anyone could say anything. That's not really how it actually works. And it's interesting in terms of claims where there might be an SIU element to it, where there's a personal injury and there's, we think that it's a bit of an exaggeration or it's fraudulent, and suddenly the insured disappears, that we can't get in contact with them, or we don't know where they are, we don't know their whereabouts. Third parties have quoted this section of the Act and said, oh, sure, he's missing, we don't know where he is, because there might be a family member, or there might be known to them. Just to say someone is missing, I think they went to England or they went to Australia, is simply not enough. You obviously have to go to the definition supplied by the Garda Síochána, which is where you're worried about their safety, and they have been reported missing. So it's not simply a case of he went to England, I don't know where he's gone now. It's not as straightforward as that. The Act allows a third party to obtain information from the insurer whether a contract of insurance exists, terms of the contract, details on the insurer, if the insurer has declined or intends to decline indemnity. So if a third party calls in to an insurance company and says, like, there's been a bit of an incident and they want to know that we insure such and such a thing, we have to give them some information. We don't have to give them all information, but we can confirm that yes, there was a policy, no, this was reported, yes, it was reported, we're declining, we're going to investigate. Just those basic details. It's not a case of we're not telling you anything, off you go, try and find out for yourself. It's to try and aid them as much as they can, but just giving them the basic information that we're obliged to give them now by the Act. So it's not really a free-for-all where we actually give them everything. I think that's what some people were afraid of, that anyone could just ring in and get whatever they want. It's not that straightforward when you actually read into the Act. Section 23 is in relation to subrogation, family, personal relationships and employment. And this section just really limits the subrogation rights of the insurer. It's limited in certain situations. The person responsible is a family member or a person cohabiting with the insured. The person responsible has been given express implied consent to use the vehicle, which is subject matter of the contract of insurance, in the event of an employee, unless the employee intentionally or recklessly caused the loss. Now, they do give the definitions of a cohabitant and a family member in the actual Act, so they are very technical. The limitation only applies where the other person is not insured for the liability to the policyholder. Where they are insured, an insurer can recover up to the amount the other person is insured for. I think that's, people kind of overlook that section a little bit as well. They automatically assume that if it's a family member or co-inhabitant, that a partner, that we weren't entitled to claim against them. We're not entitled to claim against them if they don't have an active insurance policy that will cover the incident. If they have car insurance or public liability, or whatever the insurance may be, and they have an active policy, we are entitled to recover the amount from their actual policy. It's only if they don't have a relevant policy in place that we go after them personally for the monies. That's where that comes in. But if they have a valid insurance policy in place, we are still entitled to recover our payments amounts against that. This limitation doesn't apply where the conduct of the other person that gave rise to the loss was serious or willful misconduct. So if they were breaking the law, if there was a crime, if people were telling lies at the start, that someone was driving but they weren't driving, those type of things, this doesn't come into play there, because they're a family member and they don't have insurance, but they drove the car when they were drunk. That's because they're a family member doesn't mean they're off the hook. They took the car when they were drunk, they drove the car when they were drunk, they stole the car, whichever it may be. It's willful misconduct, so we are entitled to go after that person personally to recover the amounts paid out on the policy. And then that brings us into sections effective from September 2021, which is phase 2. The utmost good faith. This is replaced with a new pre-contractual duty of disclosure on the consumer to answer specific questions asked by the insurer. General questions are prohibited. The Act imposes a duty on the consumers to answer all the pre-contractual questions honestly and with reasonable care. Consumers must be informed of general nature and effect of pre-contractual duty disclosure pre-contract. Questions must be specific, drafted in plain language, and asked using a durable medium. So durable medium is a letter, email, or phone call. Insureds are not obliged to volunteer any information over and above that's sought in insurance questions. So the ambiguity will result in the interpretation most favourable to the consumer. Non-disclosure measures can only apply where insurer can show that non-disclosure was an effective cause of the insurer entering the contract of insurance and the terms on which it did. Therefore, material fact definition of a prudent and reasonable person or that of a prudent and writer will not apply. You'll probably be used to saying that, and in the earlier insurance exams, you would have heard the definition a couple of times. So that's kind of essentially gone now. So you'd see on Word, like when you receive your renewal or when you're getting a quote, you see the word and you could think anything might be of use to us, or you think we might know anything, tell us. That's gone. You have to, everything has to be asked. If you want to know something, you have to ask it at the offset. If we don't ask the consumer, we're generally saying that we don't want to know. The consumer is under no obligation to tell us anything additional to what we've asked them. Granted, if it's something different, like if we ask them, they say to us, my car is a Ford Focus. Oh, grand, is it a 1.6 litre? Yeah, it is, yeah. It turns out they're driving a Porsche 911. Like, that's a material fact. That's not what we agreed to cover. And we probably would not have mentioned the contracts on the same terms and conditions that we have when we thought originally it was a 1.6 Ford Focus. It's those type of things that if it's a material fact that wasn't disclosed or wasn't voiced to us, that's when we can actually we can use a non-disclosure saying that no, this would have impacted how we actually entered into this contract, and we may not have actually entered into this contract at the time. So there's considerations then for the utmost good faith, the type of contract and its target market, relevant explanatory material, how clear the insurance questions are, whether the consumer is represented by an agent. Some consumers can be expected to be in possession of more information than others. And that's just to think of in terms of your renewal questionnaires or your quote questionnaires. what kind of questions you're going to ask, what kind of documentation you're going to give it to them. If you have a large commercial policy, it's not going to be the same as a private motor policy for a driver and a named driver. So insurers have to kind of give consideration to those type of things of what they're going to be asking, who they're going to be asking, how much documentation you're going to be getting. Is there an agent involved? Is there a broker involved? Is it online? Is it direct? Those type of things. So it's not going to be one size fits all. Every line of business is probably going to have something different to suit the consumers who be taking out the policy. The uppercuts of fate, if the insurer fails to investigate any absence or incomplete answers, they're deemed to have waived any further duty of disclosure unless the non-disclosure is fraudulent, intentional or reckless concealment. And that's like what we're just saying. If someone sends back a questionnaire or does a questionnaire online and something is left blank and we don't follow up on it, we're essentially saying, yeah, we're happy with that. So if something comes back blank and you want to know the answer, you have to go back to the insured or the proposer and say, we need the answer to this. You can't leave it blank. You need to give us yes, no, or whatever the answer may be. In terms of brokers or MGAs, this type of authority will see the brokers act as insurers. So the same thing, if the brokers get back the paperwork and some parts are blank or some parts aren't filled in fully, it's up to the broker to go back and ask the insured or proposer, look, this is blank, we need to confirm what the answer to this actually is and complete the questionnaire before they send it back to the insurers. This is what I was talking about on the wordings being made traditionally seen on paperwork or emails coming out. Every proposer, when seeking insurance or cover for additional risk or renewal under an existing policy, must disclose any information that might influence the insurers, reinsurers in fixing the premium or determining whether to accept the risk. Failure to do so may entitle insurers to avoid cover from inception and seek payment of paid claims. If you're in doubt as to whether information is material, you should disclose it. So if that's been displayed on any documents or correspondence issued to insured consumers, these should be reviewed as no longer correct and they will need to be required amendment because we cannot put that obligation back onto the insureds. The obligation now lies, or the onus now lies with the insurers as to the questions they ask, the information they want to know, and the information they follow up that's not been presented to them in the questionnaire or the renewal statements. The misrepresentations is a bit of a tricky one in the Act because it comes up in Section 9, it comes up in Section 18 as well. It comes up where you are taking out a policy, and then it comes up like as in when you're actually making a claim. So representation is a statement made by the proposer to an insurer relating to proposed risks. This was discussed earlier in Section 18 of the Act, proportion remedies and claims handling. So it's a bit like a jigsaw. Some of the Act, it doesn't, like you'd have Section 18 and then Section 9 go together. You have to read them together. So some part of the Act is jigsaws. When you read them on your own, it's grand, and then you move forward and you read another section and go, that doesn't make sense. And you have to try and fit the two of them together and read them as a one kind of section. So if it's material and the representation must be substantially true, any false statement on the material portion of the fact would render the contract voidable. So if you are given a false statement that goes to the heart of the contract, that means that the actual contract itself can be voided. The Act has introduced new proportional remedies for misrepresentation as outlined in the following situations. Section 9 of the Act deals with remedies available for misrepresentation. The most suitable remedy will depend on the type of misrepresentation. So the powers that the insurers had, but they could traditionally rescind the contract on the case of misrepresentation is abolished, and we touched on that earlier as well. So again, there's three types: innocent misrepresentation, negligent misrepresentation, and fraudulent misrepresentation. There's two different situations. It's when the claim comes to light, when the misrepresentation comes to light when a claim is made, and when the misrepresentation comes to light but there's actually no claim on the policy. So if a claim has been made and it's innocent, the insurer must still pay the claim. The negligent misrepresentation, the remedy must reflect what the insurer would have done had it been aware of the full facts and shall be based on a compensatory test. And the fraudulent misrepresentation, insurer is entitled to avoid the contract. So if a claim is made and something comes to light that is fraudulent, then the insurer can actually void the contract. If no claim has occurred, but the insurer becomes aware of a negligent misrepresentation, they must terminate the contract in case of life insurance, or notify the insurer that it will adopt one of the following three courses. If the insurer will have an entrance to premium contract on any terms, the insurer may avoid the contract and refuse all claims, but must return the premiums paid. So if they look at the new information that's come to light and said, no, look, we wouldn't have took this on cover, we wouldn't have offered you a policy, they can avoid the contract, but the full premium must be returned back to the proposer or the insured. If the insurer would have entered into the insurance contract, but on different terms, excluding terms relating to the premium, so it might be in relation to the cover, they might have only offered third party fire and theft as opposed to comprehensive. the contract is to be treated as if it had been entered into on those different terms if the insurer so requires. So if you have a claim and there's a third party and an insured, and it turns out that the driver has a provisional license or is a bit younger than what they said they were, or something along those lines, and the underwriters look at it and they say, yeah, no, look, we would have took the cover on, but we wouldn't have offered them comprehensive. We would have only offered them third party fire and theft, or we would have offered them comprehensive, but they would have had an excess on the AD side of the claim of €1,000. So they'll treat the claim, they'll deal with the claim, but they will impose the higher excess, or they'll deal with third party claim, but they won't deal with the own claim because they're going to not offer comprehensive on that policy. And number 3, if the insurer would have entered into the insurance contract, whether the terms relating to matters other than the premium would have been the same or different, but would have charged a higher premium, the insurer may reduce proportionally the amount to be paid on a claim. So that's where they're going to get in. They'll do a formula to figure out how much the claim they will deduct in terms of the amount of the premium that wasn't paid with regards to the risk that's proposed now after the misrepresentation came to light. I suppose an example of a negligent one is John is insured with XYZ insurance company. His occupation is an office worker. He changed his occupation to taxi driver and now uses his car for its purpose full time. An accident occurs and John is deemed liable for the accident. What happens next? What would the XYZ insurers have done if it had known this information at inception or renewal? The options available are A, refuse cover, avoid the contract, refuse all claims and refund the premium. B, different terms, but not just premium. Insurers can elect to treat the case as if the contract was entered into on those new terms. There may be certain terms in relation to using the car at specific times or passengers or that kind of thing. C, accept the risk on same terms but at an increased premium, reduce proportionally the amount of the claim. D, if there is no claim, the insurer can exercise any of these 3 options or cancel the policy by giving reasonable notice to the insured. Again, it's hard. A lot of these will probably be kind of case-by-case basis. If something comes to light, insurers and underwriters will look at each case individually. There's not going to be a one-size-fits-all for these. You'll have to look at what's presented to them. Is it really innocent? Is it negligent? Is it actually fraudulent? And then it'll be what are next steps. So the insurers and the owners will have to decide which kind of misrepresentation they think this actually is, and then the remedy that they chose to employ after they've decided which misrepresentation actually is. If it's fraudulent, the insurer shall be entitled to avoid the contract of insurance. There's no mention of the premium rebate, which suggests that the insurers can keep the premium. As I was saying, the insurers need to establish if misrepresentation is innocent, negligent, or fraudulent. It is anticipated that the threshold for fraudulent misrepresentation would be very high. It's the same as everything with fraud around Ireland at the moment. The bar to prove fraud is very, very, very high. So the amount of these that will probably sit under the fraudulent misrepresentation will be few and far between, because that bar is set so high, unless you get doctored documents in and invoices or that kind of thing, where it's very clear it is a fraudulent claim or fraudulent invoice. Renewal of contract of insurance is section 12. When you get your renewal now, what we are obliged to inform the insured is the 5 years premium payment amended if appropriate. If there's any midterm adjustments, they have to be displayed. The list of claims in the last 5 years not applicable to health insurance, and this is effective from the 1st September 2021. This is a really, really big administrative task for insurers. We wouldn't have had to give this much detail before. We would have had to give the premium, a breakdown of the premium, the government fee, that type of thing. That we would have had to advise the insured of that on the renewal quote. Whereas now we have to give them the last 5 years, and we also have to give them the last claims for the last 5 years, if there is any, on their actual policy. So that was a big ask, administrative ask, and process changes and software changes for insurers to be able to gather all this information together from a policy and display it on a document going out to the insured at renewal. So it seems very simple on paperwork that we have to do this now, but it's actually a lot of work in the background involved with getting this information together and to ensure that it's actually presenting as it should be and correctly and within the time frame as it is. I'm just conscious of the time there, sorry. Renewal duty to consumer and insurer at renewal section 14. As we discussed, there is no continuing duty disclosure. Insurers can ask specific questions, not general questions. Consumer will be under a duty to respond honestly and with reasonable care. If the consumer does not provide additional information and pays a premium, it is taken that the previously supplied information has not altered. So if there's no additional information given and the premium is paid, we take it then that the previously previously supplied information to the insurer has not changed in any way at all, that it is the same risk that we've insured. The duty to consumer and insurer renewal, utmost good faith no longer applies. Consumer will be under a duty to pay the premium in a reasonable time or in accordance with the terms of the contract. An insurer can decline a claim if a risk is considered to be a new risk as described in the alteration of risk clause and did not agree to cover it. It's like we were discussing earlier. Could be a house policy, that's fine. Something happens, you go to look at it, it turns out it's actually like a hostel or a B&B, or there's an extension built at the back and there's a large creche working at the back. That's not the risk we took on. We took on a home policy, not those additionals. So it could be a case that the claim will be declined because it's a new risk. It's not what we expected to see. Changes we can expect or have already seen: system changes, broker software, house systems, updated questions, fields not pre-filled. Certain questions are now mandatory. Answer type changing from tick boxes to tri-state boxes. So it might have been just like a tick box, but now it's like yes, no, I don't know, where they're forced to answer the question. Assumptions change to questions, declarations, guidance on way to answer certain questions. So it would be a hover test online if the question may be confusing. There'll be guidance supplied at how to actually answer it and what information the insurers expect to see answered in it. Post-quote questions for certain products. Statements of facts at all stages, new business quote, bind, MTA and renewal invitations. They'll have to be released at each stage now, a statement of fact. Document changes, updated policy documents, paper, physical version, digital versions, IPIDs, cover letter, proposal forms, renewal notice, updated new business buying packs, the 5-year claims information, the 5 years premium information, and the product update summary. I'm kind of flying through them now, sorry, because I'm just looking at the time. Process changes, we've already seen, expected to see additional questions and new business quote and renewal, requests for information provided previously, where proposal forms used may be required to complete a new form at each renewal, if information being requested and are confirmed in writing. So it's kind of going to be like a longer journey for an insurer to get a renewal or get a quote on some types of insurance, and not going to be simple as it used to be, because we do have those obligations to find out this extra information, or to find out the information that we have on file is actually correct and there is no changes to what we are actually covering. Where the insured or insurer breaches any duty to the Act, penalties can be imposed on insured or insurers for non-compliance. A court may reduce or increase the sum recoverable or payable under the insurance contract in proportion to the breach involved. As I was saying, nothing has really come to the fore yet in terms of been challenges or someone interpreted a different way. So that could come down the line now where something could be challenged by a consumer and it might end up in front of a judge, and the judge might make a decision that would set precedent then for that section of the Act. But it's a bit early yet to say that something will happen, something may happen, or something will happen in terms of penalties or non-cooperation by the insured or the insurer. So it could all come down the line that something comes out for either the insurer or the consumer. I'm going to stop talking now. Give all your ears a bit of a break. I don't know if anyone has any questions or anything for me.
Hi Denise, can you hear me there?
I can, yeah. Probably all asleep.
You're good. No, thanks for that, Denise. In particular, it was a great and eye-opening session there on CICA. From my own point of view, there's some striking points there around late notification, sharing all the information with third parties. Again, that just the mind boggles a bit at that, how that's actually going to work in practice, especially around liability claims. The retention limits and the replacement then of the utmost good faith. And you hit there a good point about the considerations for brokers too, who are often the middle people, getting this paperwork in, and their responsibilities there. I think it'll be interesting to see how this works out, over time, the bumps along the road,
Yeah, there's going to be, and obviously because phase two came into effect this year to give insurers and brokers time to actually make those system changes and software changes. So now we're going to start seeing the hurdles and the bumps, because the renewals are going to be going out and the quotes are going to go out. So now we're going to see any kind of issues coming to the forefront now in terms of that. Yeah. And hopefully everyone will try and overcome as best they can.
Oh, brilliant. Yeah, no, it's very, I'd say it's a nightmare from your end of it to actually implement this stuff, but.
It is a bit. Now, I know I was rambling there a bit, and I do apologise to everyone. And I kind of have tonsillitis as well, so I sound a bit like Kermit or something. I don't know what I sound like. If anyone has any questions, if they think of asking.
Yeah, we have one, Gina, I think.
Yeah, thanks. Just not as I'm sorry, I was a little late coming on. It's just where to put this on the terms of business, and would you put it on the statement of suitability as well?
What do you mean, Gina?
You have to highlight, your terms of business. You'll have to show the CICA. regulation. And a new paragraph for that. But would you also put it on the statement of suitability? I was just thinking of that with all the different parts of the regulation you're calling out there, to highlight it more for the customer.
Yeah, you would have to, any kind of change like that, you do have to kind of make them aware.
Yeah, because I noticed that it isn't on a lot of them. So and
most people kind of put in their iPads that, you know, they were making them aware of the change that were coming into CICA, or the change that have come in or will come in, or change that they can expect to see on their policies.
Yeah, because I mean, it's utmost good faith, like it goes back on the consumer, and I don't think they realise it yet. Yeah.
It's definitely, it's one of those ones like that's going to be, it's really going to be trial and error and see what actually happens, or what people find works best for them and their systems.
Yeah, so it's obligatory at the moment then that all insurance products, the terms of business, should reflect this.
Yeah, most definitely, yeah.
Yeah. All right, thanks, Denise.
No problem, Gina.
Any other questions on this, guys? Or I see Barry has there the 5-year premium claim summary should be understood as the previous underwriting years, and should the claims payments be shown only relate to claims which belong to the policy years shown on the premium section. Do you see that there in the comments, Denise?
I'll see if I can
chat from Barry Wallace there. It says the 5-year premium and claims summary, and should it be understood as the 5 previous years underwriting years, and should the claims payments shown only relate to claims which belong to the policy years shown on the premium section.
It has to be in relation to the 5 years. I'm trying to look for the comment. It won't let me bring it up there. Here we go. Yeah, so it is the 5 previous underwriting years in relation to the renewal year. The claims payments don't only relate to claims which belong to the policy years on the premium section. Yeah, so if the insured, I think this is what you're asking me, if the insured is with you 3 years, you're only obliged to show them the previous 3 years. You don't have to show them the previous 5 years, because obviously we don't have access to that information. I think that's what you're asking me, Barry. I'm not 100% sure. But yeah, it's really in relation to the years you have the 5 previous years to the renewal. So if you have them for 4 years previous to the renewal, you show them the 4 years, the claims and the claims amount paid. That doesn't include professional fees, so it's an accessory fee. You don't have to show that. But yeah, you would have to show them in the premium section. I don't really know if that's what you're asking me, Barry, that if you had them. If you want to clarify for me.
Sorry, Denise. And then yeah, there's a H Smith there has come in saying, oh sorry, Barry's come back there. How it's more of a consumer with a if the consumer's with the company for 10 years, then you'd have to show a claims payment relating to an underwriting from 6 years ago.
Yeah, so it's the previous 5 years to the renewal. So that would be, so if 2021, you're going back to 16. So you're going back to 2016 if it's 2021 renewal. You don't have to go in any longer than that, if that makes sense. You don't have to go back, even though they're on cover for the last 10 years, you don't have to show them the last 10 years of claims information. It's only in the previous 5 years.
Perfect. And then H. Smith noted there as well, thanking you again for the presentation. And is everything on a proposal form being capable of being misrepresented, e.g. date of birth, number of rooms in a house, etc.?
It's kind of hard to say, to be honest with you. It'll really come down to if the information supplied was affected, like if you're insuring a 3-bedroom house and it turns out you have 43 bedrooms, that type of information then could be misrepresentation. It's like negligent or fraudulent, but like in terms of the way you say it there now, it's hard to say unless a claim came up on it or something came to the forefront. But it's kind of hard to answer that yes or no.
Yeah, I think that's. Yeah. Any other questions, guys? Sorry.
I'm conscious of the fact that I only left a few minutes for questions, so my email address is there. If someone wants to email me, we can have a chat about what they're asking, and we can have a proper chat about it if they wanted to, and just I only kind of allowed a couple of minutes there at the end.
Brilliant. Yeah. Thanks very much for that, Denise, again. And I know it's a busy time of the year for you, so thanks again. It was a great session. But not just for today's session, but you've been a keen supporter of the InsurTech Network Centre and CIRDAS indeed since inception, and not just on today's session, but on the wider course development and even the validation process, which can be quite onerous. So again, I know we're drawing on your time quite a bit, but it's great to have you on board. Yeah.
Glad to help, and I'm sorry I can't make CICA more exciting. It's just one of those things. I can't, unless I put Christmas lights around my head.
No,
I can't make it more exciting.
I think that's like a lot of topics around insurance. There's only so much you can do.
Yeah.
No, but no, listen, thanks a million for that today. And just by way of a close, it's been a very busy year for us here at InsurTech Network Centre and CIRDAS, under our Insurers at IT Carlow banner. On the education front in particular, we've just completed an intensive and ambitious course approval cycle, and Denise is involved in that. And really, that's cemented CIRDAS with a compelling and ambitious offer for the future. We'll be making more announcements in this space in the new year. So make sure to follow us on the social media channels and keep in touch with us. And again, thanks a million, Denise, and I hope everyone has a merry and safe Christmas.
Stay safe today, everyone.
Yeah.
Storm Barra. Try and make sure today anyway. Yeah. Thanks everyone for listening to me, and Damon, Aidan, thanks very much as well for inviting me to give the chat.
No, thanks again, Denise. Brilliant. It was brilliant.
Thanks very much.
Thanks. Take care.
Bye.
Bye.